Okay. Good morning, everyone. Last for We have seen the Indian budget has been declared last week, and you might have remembered that we have taken a webinar 2-3 months back about aisa kab tak chalega, and we have predicted that stock market Sensex broader index will go move towards 55,000 level. Uh, we said that in last 2-3 months back, and now we are roughly around 51,000 level, and Nifty around 1500 15,000 level, 1500 15,000 level, right? So we are sticking to that position of what we have said earlier in 2-3 months back. Probably we can go farther ahead also, but today I'm going to show you some data point so that you can able to get that what exactly what this budget is mean for all of us as an investors, and what as an investor you need to do depending upon the budget. And in case if you have any query, you can get back to me personally, and particular stocks or particular investment. We are not, the scope of this presentation is not about a particular stock and investment, but a general overview about budget and personal investments. Okay, so before going ahead, just to reiterate that uh, we are continuing with the momentum of stock market. Every day you are seeing that the market is going high. Now, in continuation to what we have said 3-4 months back, I will continue to say that the market will continue to rise till we have inflation. So if the number of if the inflation number is in control, the market, irrespective of political party and what exactly happening elsewhere, it will not impact. So you need to figure out that inflation number. Inflation number, it's still lower, but it has shown a slightly higher, slightly upward movements very recently. Why, I am going to tell you, and what it means again, that I will going to tell you. Now, if we talk about, let's talk about a global economy. What exactly happened in the last 1 year? If we talk about the global economy, we have seen there is a huge printing of money by the central bank of across all the world, and that exactly what has happened. The money has pumped because of the pumping of money, printing of money by the central bank. There has been a huge liquidity in the market, and most of the investors have rallied behind the stock market across the globe. So that exactly has happened. The data is also showing that uh, over the last 15 years, we have seen the kind of money that has been printed by the central bank, and which is at highest right now. And uh, and Apple, with in addition to that printing of money, there another important point is that we are having a low interest rate across the globe. If you see the interest rate in US and Europe, it is Europe, in some country it is negative interest rate also. So once that means when you have a money in your hand and you know that the interest rate is negative, like if you park money in bank, you will get a negative return for sure. Then probably you will go for the equity investment, and that's exactly low interest rate support equity valuations, which has happened across in the last 1.5 years during the COVID period also. Now, coming back to the Indian economy, this is the budget preparation. This is the economic survey report. Like this year, we are predicting a decrease in a GDP. Last year we have decreased, but this year we have predicted a GDP growth rate of 2021 as 11%, and followed by a 10% in 21, 22, 22, 23. So there will be a huge GDP growth rate from here on. And why the growth rate will here on, you yourself will able to judge from the data which I'm going to show you in subsequent slides. Now, what are the important headlines in January? Now, irrespective of the points that COVID has impacted Indian economy, uh, irrespective of the notional people thinking that market is at all-time high. Now, what are the important headlines which has happened? We have the highest ever GST collection in January, which is 1.2 lakh crore. Power demand touches all-time high at 185.82 gigawatt. Indian manufacturing PMI improves to 57.7% in January. And to add to that, Indian forex reserve is high, all-time high. Bank credit growth increases, Indian export increases. So if you see the January data point across, active COVID cases has fallen, and Indian pharmacy of the world starts vaccinating COVID vaccine exports, and Indian quarterly GDP contraction to end in December. So if you see the January data points across all segment, which we have seen a massive improvement, and which is evident from the corporate profitability also, which I will show you in the data. Now, India, India is the fastest bounce back. India will be the fastest bounce back among all the economics going ahead. Now, if you see the data point here, in 2020, we have seen the world output as minus 3.5, and it's 2021 is 5.5, and 2022 is 4.2. Now, advanced economy, if you see the GDP number, it is 2020, obviously during the corona period is minus 4.9, and 21 it is expected 4.3, and 2020 3.1 stabilize. Now, if you see the India number out here, you know, we have seen the GDP growth rate is coming down to minus 7.7, that is 8%. Now, this year, I have shown you the data earlier, we are predicting at 11.5% and 7% in the next subsequent year. So you can see the data across all economics in the world. India is going to have a major growth among all economics in this year and subsequent year also. Why I'm going to tell you, because this budget is going to have the huge impact on that thing. Um, well, I will switch over to this thing. Real estate will support recovery. Now, real estate affordability is an all-time high. Mortgage rate has fallen to a lower level. And now, what this union budget has done? Now, what this union budget has done to India, I think after 1991, this is one of the best budget that India has produced. The reason why I'm saying this thing, each and every year, there is a two kind of expenditure which happen. One is a capital expenditure, one is a revenue expenditure. Now, this budget, you might be thinking that there has been no income tax reductions or all those things which has come to any common people, and what this budget offers to us. Now, this budget, what has offered this year is that they have invested, they have allocated huge amount of money towards infrastructure, and that is a capital investment. Capital investment, you can understand that when you increase your allocation towards capital investment, the return does not come today. It comes towards over a period of time. Over the years, we have always seen there is a huge amount of revenue expenditure. Revenue expenditure, what happened that it's normally kind of a populist measures kind of thing. Now, this budget, I will going to show you the data. They have allocated huge amount of money to the infrastructure segment, not only to the rural segment but across all segments. Now, and that is the reason why the market, after the budget, they have reacted so well and moved up the bit. Apart from that, they have addressed the banking and financial services very strongly. They have created the asset restructuring company and national infrastructure fund, where they will address all these bad loans which might be incurring India in the last couple of years or months. So apart from that, now when I say that they have allocated huge amount of money to the capital investment in building infrastructure of the country, they have pegged that fiscal deficit at 9.1%. Generally in India, the fiscal deficit, fiscal deficit, budget and revenue, expenses and revenue, was always at 3% to 4% level. Now, this year it has moved to the 9% level. A lot of people were thinking, economists were thinking that the fiscal deficit is huge, but we should not be worried about fiscal deficit this year. The reason why, there are two reasons. Number one, this fiscal deficit has included COVID package also. So this 9% fiscal deficit this year will not continue next year. That's number one. Second thing which has happened, that food subsidy was always outside the budget preview uh, till date, but this year they have included the food subsidy as a part of the budget. So that is, these two factors has led to the fiscal deficit of 9%. If you see the projection of fiscal deficit next year, it will be much lesser. It will be round about 6% or 7%, and next 3 to 4 years you will find the fiscal deficit to come down to the 4 to 5%, 3 to 4% as a normal range. So that is not to be worried about. Now, when we talk about the fiscal deficit, there is a huge deficit, the revenue and the expenses, where they will collect from. Now, they will collect the money from privatization of a lot of PSUs. They will seek the valuations of those PSUs and make it more smarter. If you see the GIC, there are 4 or 5 GICs in India, and if you see the kind of profitability, kind of performance of the GIC is not well. So it is good that they will make some of the GIC more active and more profitable. Air India, which was supposed to be privatized a long time, this time they are going to make it. LIC, they're also planning to have a small amount of outlay of 20-25%. So the money will come in from there. Apart from that, the government will do some borrowing also. So going ahead, so that's what the fiscal deficit, how the government used to manage this time. And considering all of this, you will see the market has reacted very strongly to that in last 1 week. This budget has actually pushed India towards the Atmanirbhar for fiscal growth, accelerated growth. It's a very bold for healthcare sector, self-reliant for defense, transformational for PSU, which I told you right now, ambitious for infrastructure, innovative for raising resources, progressive for women empowerment, metamorphic for capital market. Why metamorphic capital market? We have already mentioned that the government has formed the asset restructure company and national infrastructure fund to address all the bad loans which might be occurring and which have already been occurred. Imparting on taxpayer and transparency in accountancy. So all those things have been addressed in this budget this year. Now, as I mentioned, the revenue deficit, a growth-oriented fiscal service in a path to recovery. If you'll see the revenue deficit figure, 9.5%, which I've already told you, I mentioned the figure. Going ahead, you will find this data fiscal deficit coming down, and how the coming down I've already mentioned to you. As I mentioned, there's a huge capital outlay from the central government. If you'll see that since 2009, if you see the PAC capex and the total capex growth and the central government capex, it is the highest ever capital investment done by the government this time. PSU capex to growth at 9%. This is all segment-wise where they have allocated oil and gas, minister. If you see the data point in every sector, they have allocated huge amount rather than the previous one. So that's a huge growth from what exactly we have seen earlier, and huge allocation to different PSUs and different infrastructure projects. Well, this is a continuation of other slides. I'm skipping this thing. Okay. Now, if you see the sector outlook, what are the sectors that going to be a positive from market point of view? BSFI, banking and financial service, will be extremely positive from now on because of the setting of asset restructuring company, because of huge infrastructure outlay. You will see a lot of funds coming up from the government. Government will try to spend as much as they can, which will eventually create a lot of employment in the market. And it's a good for the banking and corporate banking especially. So there is a two kind of banks. So one is a retail bank, one is a corporate bank. So say for example, ICICI is a corporate bank and HDFC is a retail bank. Okay, how they define that if a bank has a 75% or more funding from the corporate sector, it is called a corporate bank. Vis-a-vis 75% and more from the retail, it's called a retail bank. So you will see a huge pump up from the corporate bank segment. SBI is also a corporate bank, for example, and there are a lot of other banks also which are corporate banks. So corporate bank is going to immensely benefit from here. You will see the share price of ICC in a couple of days' time. But again, to note this presentation is, I am not mentioning any particular stocks or not referring any particular stocks to investment. For that, you have to consult to me privately. I will discuss and figure it out for that. Agriculture sector, obviously, it's a huge positive. FMCG will be mixed. Auto, infra, real estate, power, aviation, capital goods, and pharma will be extremely positive. Why pharma is positive? Because irrespective of the pharma, irrespective of the huge spending government has allocated towards the health sector, India is going to have its own API from now on. And earlier, what India used to do, that they used to take it from the China API and used to consolidate all the raw material and produce the pharma component. But now on, India will focus more towards the research and build capabilities inside. So you will see a lot of research and development activities happening in the pharma, and that will going to push up. So that's a sector specific which I mentioned here. Now, having said that, market is at 51,000 level. Now, what are the risks? Obviously, there has to be some risk in the market. Like, what should we do? Like, having said all the positive right now, what is the risk associated with the market? Now, when I talk about the risk, the number one risk still lies in a COVID. Although India has managed extremely well the COVID situations, we have seen COVID situation is still very worse, still in UK, in US, even in a couple of European countries, in Portugal, you will see that there's a worst COVID situation. They do not have hospital beds available, and then we have seen that the patients, ICU patients, have been shifted to other European countries for treatment. So COVID is continue to be an international problem, and this is the risk of COVID. New strain coming, it still lies, but it's one of the most threats that remain. Second most important threat I have always been mentioning is that inflation. Now we have seen there has been a slightly increasing commodity prices across the world. Now what has happened that since US has, I have already shown you the data how the all the bank across the globe has printed money in last 1 year, 2 years. They have printed money huge, but inflation has not gone up. Why? Because most of the investor they have invested in stock market rather than investing in commodities. Now some point of the other, this excess money supply in the market will actually lead up to the price to shoot up. It will has to come down, come to the market, not to the stock market. Now we need to closely watch the inflation number. If you see the global inflation in US and every country, it is still under control as of now because all the central bank are actively monitoring that. But we have seen the crude price, we have seen the commodity price had slightly increased. And if this commodity and crude price increase figure continue to increase in next to 2 to 3 months, all the central bank will squeeze it. All the liquidity which are available in the market, you will see the US Fed, the Indian government, and everyone will try to absorb that. Now, once all the central bank try to absorb the excess liquidity to the market to curb inflation, you will see the market falling down. So the only biggest worry what I'm having right now is inflation number, not any political party, not any other factors. So keep a watch on the inflation number, and that will exactly is going to tell you. Now, when the inflation will shoot up, obviously it is bound to shoot up because there is a huge amount of money supply in the market right now. Exact timing, no one knows. Okay, so that's one of the worry which lies. And India perspective, I will say that the unemployment rate has come down because we have seen that a lot of the laborers which have gone to their own native places during the COVID time, they've come back to the cities. They're coming down to the cities right now and started working, but income has not increased. The income of the people where they have lost job, the income which has been reduced due to the COVID, it has not increased right now, gone back to the level. Pre-COVID level. So income has to be increased for people to spend more. And if people do not spend more, it will not reflect in the corporate say top line and bottom line. So that income has to raise. The third point is that income has to be factored. Fourth point, which I'm going to say, is that current account deficit of India. But India, we are extremely better off position as far as the current account deficit position. So that is not a worry point. So the four factor which you need to look out, COVID, I think it is more of control right now. Capital current account deficit, it is controlled right now. The important factor here is inflation number. So that is the only risk factor according to me which we have. We don't know when the inflation will shoot up from here. If the inflation shoot up, the central bank will curb the liquidity, excess liquidity available in the market, and I will see a meaningful correction across the globe. When I talk about the meaningful correction, it could be 15 to 20% right now. Standard and Poor, S&P index has been rising like anything for the last 1 year. Now, this massive bull market, we all know the market is cyclical. This massive bull market has to come down. The only trigger point you will have when the US inflation will increase, and when the inflation increase, you will see the US Treasury bill, US Treasury yield, the GSEC bond yield here in India, US Treasury yield going up. So that's the only point which is a worrisome right now. But exact timing, we don't know. What need to be done here, I'm going to tell you on a subsequent slides. Now, coming back to the equity market, सारे जहां से अच्छा इंडिया हिंदुस्तान हमारा. So that is been evident from the FI flow in last 1 year. If you see the FI flow in last 1 year, India received $24 billion, whereas no other country is nearer to it. And this is continue to increase till the time we have the other parameters which I have told, inflation, all this thing is controlled. India is continue to get the lion's share of the global money in days to come because what we know, what will happen to China, what we know the Indian potential is all about. So that is going to happen until you have a huge FI flow. Market is continue to move towards the next upward movements, and you will have a new high days to come. So that's one positive side. Another thing which has happened in last 10 years is that if you see in 2020 to 2025, Indian market was dominated by the FI. FII flow, if there's a huge FII flow, market moves up. If there's a huge FII flow outflow, the market comes down. 2015 onwards, this has slightly changed. FI flows change. We have seen a much retail participation in India, this data, and as well as we have seen a huge amount of money being pumped in by the mutual funds and ULIP products into the market. So DII participation, this is a retail Indian participation, this is the institutional Indian participation by way of mutual funds and ULIP, has increased tremendously, and so we are not solely dependent on FII flow, and we are not solely will not be impacted solely by the FII flow right now. So that's a positive point for India. Even if something happened in the US market, the inflation goes high, and in the European market, and so we will be impacted, obviously, but the impact will not be as sharp as which is going to be there in last 10 years. In 2008, we have witnessed in the subprime crisis, market fallen down to like 21,000 to 8,000 level in a span of a week's time. Now that sharp correction will not happen this time because we are not solely dependent on FI what we are used to have earlier. That's one. Uh, Now, if you see the performance across segment, if you see the in 2020, there is all segment as we have seen as a negative growth. But if you see the January quarter, we have seen a massive growth in January performance as of 31st January, all segment, which has been evident from the market index also. I'm not going to discuss more about this point. Now, here is another important data point to all those people who are saying that there is no actual things that are happening in the market. Only the market is moving high. It is absolutely wrong. December quarter results, we have compiled 102 companies' December quarter result. Now, expected sales, we have sales growth to be expected was 2%, and then we have a 1% growth. Now, we have a EBITDA, earnings before interest and tax, was expected to increase by 16%, and we have grown by 24%. If you see the profit after tax, all 102 top line Indian companies clubbed together, we are expecting the profit to go by 13%, has gone to 32%. Understand the difference. Expectation of sales was 2%, but if sales has increased only 1%, but that from 13% has increased to 32%. If we see the Nifty 29 companies, okay, this is a subset of 102 companies, similar data is there. Sales is more or less similar, but you have to see the huge PAT grow, profit after tax grow by, which was expected 4%, has grown by 24%. Now, why this thing has happened? Why this thing has happened? Because in COVID period, what happened that a lot of the companies had cut cost tremendously. Most of the employees were working from home. Most of the employees, they have layout or they have reduced salary, and they have hugely reduced their administrative cost. And the companies have become much more smarter, and that exactly resulted in the PAT figure. This data is from the MOSL research firm that we have usually get, and this data is exactly the thing. And if we continue to with this data, now today what is going to happen is that at market at 51,000 level, people are saying that the PE ratio is much higher, price to earning ratio is much higher. But if we are going to see a huge PAT, profit after tax, going ahead, which I'm expecting to happen in next March as well as in June quarter, you will see the PE ratio will automatically come down. If the profit increases, the PE ratio comes down. It's a normal figure. So we don't have to worry about the Indian market, and as well as the top line and the bottom line is concerned. Okay. And I'm going to show you a couple of companies data point. Now, this company that I've shown you, it is not an indicator that I'm going to tell you to invest in this particular stocks. This is illustration purpose only. If you see the sales of Ultratech, right? If you see the sales of Ultratech, it has all increased. Ultratech, Supreme, Asian Paints. You see the Asian Paint sales in FY fourth quarter, if you see, and if you see the projected figure, which is all increased, right? Sales growth, couple of companies has decreased, and but if you see the FY21, FY2021, you will see a huge increment in FI sales growth figure, which is evident from the PAT figure also. If you see the bumper quarter result of December 20, okay, so December 20 quarter result, if you see across all companies, uh, it is quite evident that the fourth quarter, if you see evident that all companies has increased tremendously. The Ultratech, Supreme Cement, you will see the Bajaj Auto, and all these companies, they have increased tremendously. So on a overall, what we are going to say that valuation wise we are at neutral weight, and momentum wise we are overweight. So neutral weight doesn't mean the selling equity. We are recommending that book profit on excess position. So wherever you're finding your stocks or funds are having an excess profit, book the profit right now and stay invested in equity, because only factor is inflation, where we can have a curve, where we can have a meaningful correction. Otherwise, the market, as I showed you the data earlier, it is not going to come down from here. Okay. Uh, Couple of few data points. Market cap to GDP, India as of now is 98%, which is much higher than the average 75% in the inceptions. But if you see the international data point, it is 115%. So India is still much lesser than what market cap to GDP global figure. Okay. If you see the P ratio, the P ratio, Nifty P ratio, obviously it is a slightly higher as per the 10-year average, as well as the PV ratio. But as I mentioned you earlier, you're going to see the huge profitability numbers in coming quarters to come. And the profit increases, the P ratio will come down. So this is not a worry at all. Okay. Um, Earnings are increasing. This is another data point. In December 19 quarter earning, adjusted PAT was about 117.117. March, we have a lesser PAT. June, we have a still lesser PAT because of the COVID. Now, if you see the September profit after tax across Indian top 100 companies, you see 175,374. Now, if I adjust that PAT accordingly, annualize that PAT is coming about 701,496. So as I mentioned earlier, if the profitability keep on like this, okay, and I assuming it will remain like this, your P ratio will come down from 46 to 29. So that's the normal thing that we are mentioning. So don't worry about the higher P ratio right now. That is the normally what we are mentioning about your position should be right now. You should be marginally overweight in small and mid cap. You should be marginally underweight in large cap. In large cap, what I will recommend that book excessive profit that you might be having, but stay invested in large cap. Okay, and small and mid cap, you can marginally increase your allocation right now, but based on the good companies also. Now coming from, so that's what about equity. I have not mentioned all the companies which I have mentioned right now, Asian Paints, Ultratech, and all these things. These are not our call to investments. This is only for illustration sake. If you want to have an individual stock, you can always consult later on, and we can discuss over it. Now, second important thing: should we invest in gold right now? So gold, we have seen there is a decent correction in last couple of weeks time. We have highlighted that the risk of import duty being reduced to our gold call. Now this is same in the budget. Budget, we have seen the same as played out in this budget, as the import duty rationalized from 12.5% to 10%. Now if the import duty reduces further, you will see there is a drop in the rupee gold price, but we don't see a further major import duty cut in gold, and subject to some kind of volatility here and there, gold, we remain bullish for the longer term, and it has reasonably been corrected in last month or so. So you can have a small kind of allocation in gold. Suppose 100 rupees you have, so you can 5 to 10% you should have an allocation towards gold. And another important point is that if the inflation number, which I've always mentioned, that it is bound to come. We don't know 3 months, 6 months, 9 months, and 12 months. If the inflation hits higher across the globe, you will see the gold price moving higher up from here. So a small allocation, 5 to 10% of your entire portfolio, should you park in gold, since it has already corrected 15 to 20%, 15% approximately from the higher upside in last 1 month or so. Now, we have talked about equity market, we have talked about gold. Now we are going to talk about the fixed income instrument. Fixed income means government bonds, fixed deposit, and all those things, and what need to be done. Now, when we talk about the fixed income, we have seen there's an yield movement recently. This is normally the rate of interest of across available in all segment. Bond or fixed income instrument as such, I'm going to take a separate webinar to make you understand how bond actually work. When the yields moved up, you will see the 10-year GSEC yield, 10-year GSEC. This is the benchmark yield in India. Now, this is the safest interest rate that India can have. Gilt is a government security. So 10-year government security is currently available at 6.13% as of 2nd February. Now, if you see a month back, it was available at 5.86. So there has been an increase of 0.20 in a gold, 0.30 in fact, in a 10-year GSEC gilt. That means the interest rate has gone high. Now, when the interest rate go high, when there is a chances that there could be indicated there could be inflation going high. So this data point is actually saying that there could be a potential inflation worry, and this data has already also increased because of the huge government borrowing program which is announced in the budget. So that's one thing. And what we and yesterday there was an RBI policy. RBI has not increased the rate, not decrease the rate, and I don't think that RBI is going to reduce the rate this year because economy is performing well, and I don't think so RBI will increase the rate also because things are still under control. I'm going to show you the Indian inflation number. So but this 20-30 basis point increase in yield, government yields, actually will bring down the price of all existing bond. So how the yield movement works, that's not a purview of this presentation. I'm going to take separate presentation to make you understand how yield movement works in bonds and how you can get maximum benefit of bonds. So going ahead, this if you see the 10-year GSEC, if you see the AAA paper and all this corporate bond paper, you will see the different rates available out here. Bank FDs right now in 5 to 6% hovering around. Couple of them are giving a little bit slightly higher interest rate. So I don't see there is a much movement of interest rate up and down from here. Plus minus 30 basis point up and down, upside will happen. So this 6.13 can go up to 6.5 because there is a huge government borrowing will going to happen. So if you're going to looking for a fixed instrument, be rest assured that 6.5 is going to be a rate of interest in this year. And so technically, I'm not going details into the dead bond yield factor because that will take a longer time, and that's not a purview of this presentation. Um, so that's what liquidity in government is high. Government is INR 9,000 billion liquidity there is in the systems. Now, if you can understand that if they squeeze this liquidity, then you will find the interest rate movements. Uh, so that's what money is lying with the RBI. Okay, so that's what I mean to say in that thing, $9,000 billion. So that's the RBI. That's a rate movement which has happened, short-term rate movements. Uh, I'll quickly move over. Now, this is the inflation number which we have right now. I've already been mentioning inflation number. So core CPI is currently as 5.5%. Now, if it moves beyond 6%, that's a worry. Okay, so if you have seen this data point, if you move beyond 6% that's a worry. But so what we are seeing is that it is comfortably placed around 5.5%, and if in case it moves up, you will see the government increasing the interest rate from here. So this data point is important. This is the most important slide across all the slides which I mentioned, and it will actually give you an indicator of what equity market, bond market, and everything will go. So that's what is about. Uh, I'm not going to touch base on this factor more. Borrowing calendar put pressure. I've already mentioned this thing. If you see the debt market activity in FII have been investing in Indian debt market, buying bonds, but in January they have sold a little bit of bonds in Indian market. Uh, so I will skip to this thing. Liquidity in the banking systems is comfortably placed. I've already mentioned all those points out here, and so coming back to conclude this presentation today, economy, where while COVID impacts economy, but there is likely to be a huge improvement in Indian economy, as all the data point which I have mentioned, all the government figures which I have mentioned, the government budget, uh, spending and all, which actually impacts economy, and it will going to have a huge growth in Indian economy. The GDP growth rate, which is government is expecting this year plus next year, is I think is a quite realistic figure. Corporate earnings, I've already shown you it is going to increase because COVID has made all the corporates much smarter, much leaner, and that result is evident from the data point which I mentioned. FII flow will continue to be there. DI flow will we have seen a couple of short-term booking, short-term profit booking by the DI recently. But FII will continue to flow. This is talking about the equity market. Don't mix it with the debt market. And we will have a policy supportive and we will have a good supply of corporate papers and bond papers. So overall market, we are extremely positive in next 2 to 3 years, next 3 to 4 years. In fact, in 2024 and 25, we are expecting market to reach at 75 or 80,000 level. Uh, but in short term, the risk lies in inflation. Now, now we can have a very, very meaningful correction if the inflation number, which I've already been mentioning right now, shoots up, and which I am expecting that can happen with the kind of money supply. You will see the $9,000 billion is available in the Indian market right now. There's a huge amount of liquidity in a global market also. So when there's a huge money supply available in the market, there is always a chance that inflation can go high. So that's the only risk factor we have of inflation. Otherwise, I don't see there is any point, any problem as far as the corporate earnings goes, as far as anything goes that can impact market in a shorter terms. Okay, so what you need to do as an investor is that number one, if you have a meaningful profit in any stocks or funds, you take positions, you book profit. Uh, and but do not move out from the equity. For fresh allocations, I will suggest that go with an asset allocator kind of funds, where the funds where your money will move between equity, debts, and gold. uh, Gold, you can have a 5 to 10% of your entire portfolio investments, because that will hedge you in case something inflation shoots up and all, and then gold price will bump up. And fixed income instruments, FDs, and all those bonds, you're going to expect a return between 6 to 7% in next 1 or 2 years. It will not going to high from there. uh, Bond, yes, it's a good investment, but you need to understand bonds well. You need to understand how bond operates, that you can attend one of my webinar, which I'm going to take in days to come, to understand how bond. There you can actually make return of 10 to 12%, but bond is a slightly different thing. On a nutshell, a fixed income, you can expect 6 to 7% interest. So that's what is about from today's my side. I have mentioned you what is going to happen in the market in days to come. Whatever I mentioned today, it is my personal opinion, and I have not disclosed any particular stocks to be invest upon here. That's a SEBI regulations that we normally have to say. And if you please do your own due diligence before investing in any stocks or investments. Do drop by for any query about your personal investments, and I will get back to you. And thank you, and stay healthy and stay safe. Uh, you For any query, you can always get back to me. Thanks.